Have you ever thought about how to protect your wealth from inflation? As the cost of living continues to climb and economic uncertainties rise, it's more important than ever to safeguard your hard-earned money. Inflation can erode the value of your savings, but with the right strategies, you can shield your finances and even grow your wealth. In this guide, we'll cover 8 proven ways to combat inflation and secure your financial future. Whether you're just starting your investment journey or you're a seasoned pro, these tips will help you make informed decisions for long-term financial stability. 1. Equities stocks. Historically, the stock market has been one of the strongest long-term inflation fighters. Equities, or stocks, provide investors with an opportunity to benefit from the growth of companies that are capable of adapting to inflationary pressures. When inflation rises, companies with strong market positions and the ability to raise prices on their goods and services can continue to generate healthy profits. Specifically, focusing on dividend aristocrats or companies with significant pricing power, such as those in sectors like healthcare, energy, and utilities, can be an excellent strategy. These sectors tend to weather inflation better than others because they provide essential services or products that are in constant demand, regardless of price hikes. Dividend aristocrats are companies that have consistently increased their dividends for 25 years or more. These stocks not only offer the potential for capital appreciation, but also provide a reliable income stream that can keep pace with inflation. For those seeking lower risk and broader market exposure, another effective method is investing in low-cost index funds or exchange-traded funds, ETFs, such as those tracking the S&P 500. These funds spread your investments across various industries, minimizing risk while capturing the overall market growth. By investing in a diverse range of companies, index funds provide built-in protection from the volatility of individual stocks, allowing your money to grow steadily over time. The S&P 500, in particular, includes many companies with strong pricing power and inflation-resistant business models, making it an excellent vehicle to combat inflation. As the economy grows, so does the value of these investments, helping protect your money from inflation while ensuring it grows alongside the market. 2. Real estate and REITs. Real estate is one of the most reliable ways to hedge against inflation due to its status as a tangible asset. Property values and rental income tend to naturally rise in line with the cost of living, offering a safeguard against the eroding effects of inflation. Whether residential or commercial, properties generally appreciate in value over time, providing an asset that can help preserve wealth. Additionally, rental income from properties often adjusts with inflation, ensuring that landlords can continue to generate a steady cash flow, even as costs rise. This makes real estate a highly attractive investment for those looking to protect their money from inflation, while also benefiting from long-term capital appreciation. In the face of rising property prices, real estate offers a unique advantage. Unlike other assets, such as cash or bonds, which lose value during inflationary periods, property values often rise due to increased demand and the limited supply of land. For those not wanting the burden of managing physical properties directly, real estate investment trusts, REITs, offer a great alternative. REITs allow you to invest in real estate through the stock market without having to deal with the day-to-day responsibilities of property management. Many REITs focus on high-demand sectors, such as healthcare facilities, shopping centers, and industrial properties, which are essential services that tend to thrive during inflationary periods. This makes REITs a highly effective and passive way to gain exposure to the real estate market and hedge against inflation without the risk or hassle of owning physical properties yourself. 3. Treasury inflation-protected securities. Tips. If you're seeking a more conservative investment option to protect your money from inflation, Treasury inflation-protected securities, TIPS, might be the right choice. TIPS are U.S. government-backed bonds that are designed to increase in value with inflation. The principal value of these bonds is adjusted based on the Consumer Price Index, CPI, so your investment grows in line with inflation. TIPS are considered a safe haven for conservative investors, particularly those nearing retirement. They offer the added benefit of being backed by the U.S. government, making them virtually risk-free. While TIPS may not deliver the same high returns as stocks or real estate, they provide a solid, inflation-adjusted income stream and a safe place to park funds. 4. Gold and precious metals. Gold has long been regarded as a store of value and an effective insurance policy against currency devaluation. When inflation rises, the purchasing power of fiat currencies tends to fall. In such times, the value of gold and other precious metals often rises, making them a strong hedge against inflation. Investors looking to gain exposure to gold can do so through various means, such as purchasing physical bullion or investing in gold ETFs. Gold ETFs allow you to invest in gold without the need to physically store or protect the metal. Analysts generally recommend allocating around 5 to 10% of your portfolio to gold or precious metals to stabilize your investments during times of economic uncertainty. Precious metals like silver, platinum, and palladium also offer similar benefits. While these metals are more volatile than gold, they still serve as a hedge during inflationary periods. 5. Commodities. Commodities, including raw materials such as oil, natural gas, and agricultural products, are often at the mercy of supply and demand dynamics. These price fluctuations can make them an effective hedge against inflation, as commodity prices tend to rise when inflation accelerates. One way to gain exposure to commodities is through broad commodity ETFs, such as DBC, the Invesco DB Commodity Index Tracking Fund. These funds provide access to a diversified basket of commodities, allowing you to hedge against inflation without needing to purchase and store the physical products. You can also target specific sectors, such as energy or agriculture, by investing in sector-focused funds. For example, energy-focused ETFs will primarily invest in oil, natural gas, and related industries, which tend to see price increases during inflationary periods. 6. Series I Savings Bonds, I-bonds. One of the simplest and safest ways to protect your savings from inflation is through Series I Savings Bonds, I-bonds. These bonds, issued by the U.S. Treasury, pay a fixed rate plus an inflation rate that adjusts every 6 months. The inflation rate is tied to the Consumer Price Index, CPI. So as inflation rises, so does the value of the bond. Bonds are virtually risk-free since they are backed by the U.S. government. They are an excellent option for conservative investors looking for guaranteed protection against inflation. However, there are annual purchase limits, so each person can only buy up to $10,000 in I-bonds per year. I-bonds can be an effective way to park your money for the long term, ensuring that the value of your savings keeps pace with inflation while offering a guaranteed return. 7. High-yield savings accounts, HYSA. While cash generally loses value over time due to inflation, moving your idle funds into a high-yield savings account, HYSA, or a money market account can mitigate some of the impact. These accounts offer interest rates significantly higher than traditional checking or savings accounts, helping you earn more on your savings. While the interest rates on HYSA may still lag behind peak inflation levels, they offer a safe place for your money, especially in times of uncertainty. You can use these accounts for short-term savings or emergency funds, providing liquidity and protection against inflation. It's important to shop around for the best rates, as different banks offer varying levels of returns. 8. Alternative assets, Bitcoin and infrastructure. In recent years, Bitcoin has gained traction as a digital gold alternative, offering a hedge against inflation. Bitcoin's fixed supply and decentralized nature make it an attractive option for those concerned about currency devaluation. However, Bitcoin is highly volatile, and its value can fluctuate dramatically, which means it's important to be cautious when investing in it. Another promising alternative asset is infrastructure funds. These funds focus on long-term projects like cell towers, data centers, and transportation infrastructure. They provide steady, inflation-linked cash flows because their long-term contracts often include escalations based on the Consumer Price Index, CPI. Infrastructure investments can offer a stable source of income, even in inflationary environments. There you have it, the top 8 ways to protect your money from inflation. From equities like dividend aristocrats to innovative alternatives like Bitcoin and infrastructure funds, these strategies are your best defense against rising costs. Inflation may be inevitable, but with the right approach, you can stay ahead. If you found this information useful, don't forget to like, share, and subscribe for more updates on personal finance and investment strategies. Let me know in the comments which inflation protection method you'll try first. I'll see you in the next video.